how does a single missile strike halfway across the world overnight dictate whether you will be renting or buying a home next year?
I mean, it sounds totally absurd when you put it like that.
Right, almost like a conspiracy theory. But we are pulling from a really massive stack of sources today. Global market data, geopolitical risk reports, real estate analyses.
Yeah, and we're tracing this invisible yet incredibly powerful domino effect.
Exactly. So in today's deep analysis, we're going to follow this chain reaction. It starts with a military strike in the Middle East, travels right through the global energy grid, ripples into the bond market, and eventually lands right on your front doorstep.
Yeah, driving the financialization of the American starter home. It's wild.
It is, because we are basically watching macroeconomic theory play out in real time.
We really are. And, the speed at which these dominoes are falling, it's pretty unprecedented.
Yeah.
To understand where we're going, we first have to look at the 72-hour whiplash we just witnessed in the energy markets.
Oh, that whiplash was crazy.
Right. The volatility has been severe enough to give veteran commodity traders vertigo. I mean, one day, crude oil plummets over 5%.
Because the market was pricing in the hopes of a U.S. Iran peace deal, right?
Exactly. A deal that could guarantee the Strait of Hormuz remains open for shipping. The global economy was essentially breathing this massive sigh of relief.
Right, but then
Then the very next day, oil surges roughly 2% following reports of fresh U.S. strikes on an Iranian military site.
I was actually looking at the specific numbers in the market reports, and we saw Brent crude rebound to around $96.19 a barrel.
Yep.
While U.S. West Texas Intermediate, or WTI, settled around $90.41. The market is just violently swinging between these narratives of peace and war. It feels like Washington and Tehran are doing two completely contradictory things at the same time.
Yeah, they are talking at the negotiation table, but they're also authorizing strikes.
Right, which makes no sense to a casual observer.
Well, we're witnessing a geopolitical strategy that analysts call negotiation by fire.
Negotiation by fire. Okay.
Yeah. In high-stakes environments, diplomacy and military action, they often happen simultaneously rather than sequentially.
Yeah. Okay.
The U.S. wants a diplomatic deal, sure, but they absolutely refuse to let Iran use the Strait of Hormuz as a physical bargaining weapon while those talks are ongoing.
So they're actively utilizing military force to stop that physical leverage,
Yeah.
like drones, missiles, or mine-related activity.
Exactly. Diplomats are negotiating in conference rooms to secure the future, while military units are enforcing hard boundaries on the sea today.
So the market is just caught in the crossfire of this strategy.
Basically, yeah.
But, I mean, why is it swinging so wildly? Why doesn't the market just wait to see what happens instead of, panicking on a daily basis?
Because oil is no longer functioning as just a commodity. It is transformed into a live probability meter.
A probability meter. That's a great way to put it.
Right. Traders are constantly trying to price in the final outcome before it actually arrives, because being late in the energy market means losing billions.
Oh, for sure.
So a credible rumor of a peace deal reduces the probability of a massive supply disruption, so the price drops.
But a military strike increases the probability of regional escalation, so the price immediately spikes.
You got it. The market is attempting to price in diplomatic hope, but it remains absolutely bound by physical reality.
Speaking of physical reality, the market data we're reviewing highlights this, like quiet alarm bell ringing in the background. The American Petroleum Institute just released their latest figures.
Yeah, the API data.
Right, and for those who might not follow energy markets daily, the API tracks U.S. crude oil inventories. And their weekly reports are considered basically a leading indicator of our physical supply.
A very crucial one, yeah.
The numbers they just put out showed U.S. crude stockpiles fell by 2.8 million barrels last week. And the reports emphasize that this is the 6th consecutive week of declines.
So think of global oil inventories like the shock absorbers on a car.
Okay.
If you are driving on a smooth, freshly paved highway, you don't even notice your suspension. You don't need it.
Right, because there are no bumps.
Exactly. But when the road suddenly turns into a series of gravel ditches and potholes, those shock absorbers are the only thing determining whether your vehicle stays somewhat stable or violently loses control.
Wow. Okay. So when inventories are high, we have thick shock absorbers.
Right. The market can absorb unexpected supply shocks easily. But after 6 straight weeks of aggressive drawdowns, the market's shock absorbers are dangerously thin.
So every headline, every drone strike, every geopolitical bump in the road is now felt violently through the entire chassis of the global economy.
That's exactly it.
You know, I kept seeing this term in the financial papers we're analyzing today, backwardation.
Yes.
Backwardation.
The reports note that the July Brent contract is sitting around $96.19, but the August contract oil delivered a month later is significantly cheaper at around $93.89.
Yep.
Normally, you'd expect things to cost more in the future. I was really trying to wrap my head around why near-term oil is suddenly more expensive.
It's a great question. Is it basically like paying double for a case of bottled water hours before a hurricane makes landfall, rather than buying a voucher for cheaper water next month?
That is a perfect analogy.
Because you don't care about next month. You need the water to survive today.
Exactly. The physical buyers in the market, the refiners producing gasoline, the massive logistics companies keeping supply chains moving, they are experiencing that exact panic.
They need the oil now.
Right. The financial paper markets might be hoping for peace eventually, but the companies that actually touch physical barrels of oil are screaming that there is a severe shortage today.
So they're willing to pay a massive premium to guarantee immediate supply.
Yes. When a market enters steep backwardation, it is flashing a severe warning sign about imminent physical scarcity.
And we have to look at what this scarcity collides with next, because the research points toward something analysts are calling the July red zone.
Oh, the July red zone. Yeah, this is the ultimate stress test for the global oil system.
Because it combines three massive macroeconomic pressures simultaneously, right?
Exactly. First, we have rising summer travel demand, which means more people driving, more aviation fuel burning, and more goods moving across the country.
Makes sense.
Second, we have those falling API inventories we just discussed, meaning our physical buffers are largely depleted.
And
Third, we have the unresolved, escalating geopolitical risks in the Strait of Hormuz.
And just to remind you listening, the Strait of Hormuz is not just another shipping lane. Roughly 1/5 of all global oil flows move through that single, narrow choke point.
It's a massive bottleneck. So far, coordinated emergency stockpile releases by Western governments have plugged the gap and kept prices somewhat manageable.
But those emergency buffers are finite.
Highly finite. If we hit peak summer travel demand and those governmental buffers run dry while the strait remains militarily restricted, we move from headline-driven price volatility to actual physical scarcity.
Okay, let's push the first big domino in this chain. Let's say diplomacy fails, the strait is restricted, and Brent crude breaches the psychological and economic barrier of $120 a barrel. What happens to the broader economy?
A breach of $120 triggers a devastating inflation loop.
Really? Just from oil?
Oh, absolutely. An oil spike of that magnitude goes far beyond expensive gasoline at the local pump. It acts as a universal, unavoidable tax on the entire global economy.
Because everything requires oil to move.
Right. It drastically increases the operating costs for aviation, international shipping, domestic trucking, food delivery, manufacturing inputs, and even basic utility costs.
But wait, doesn't the Federal Reserve usually ignore temporary energy spikes? I always thought they treated things like oil and food as volatile categories and preferred to focus on the underlying economy when making their interest rate decisions.
They certainly try to look through temporary commodity spikes when they can.
Right, so why wouldn't they just look past this geopolitical event?
Because the danger arises when the energy shock bleeds into the core economy.
Bleeds in how?
Well, if those high oil prices persist for weeks or months, a major shipping company can't just absorb the losses. They pass those fuel surcharges onto a national grocery chain. And then the grocery chain passes those transportation costs on to the consumer. Suddenly, core services, public transportation, and basic food distribution are all inflating rapidly.
So it's everywhere.
Exactly. The Federal Reserve cannot ignore the situation when energy costs infect the broad economy and trigger second-round inflation.
Second-round inflation. That's essentially the wage price spiral I keep reading about, right?
Yes, exactly. The first round is simply the energy costs going up. The second round is the psychological and structural shift.
Meaning people demand more money.
Precisely. When the cost of moving, heating, and eating skyrockets, workers are forced to demand higher wages just to maintain their basic standard of living.
And when those wages go up, corporations are forced to raise the prices of their goods again to cover their newly inflated payroll costs.
And that is how inflation becomes structurally entrenched.
Which puts the Federal Reserve in an incredibly dangerous position.
Oh, they fall directly into the Fed trap.
The Fed trap.
Yeah, this is the classic textbook definition of a stagflation dilemma.
Because $120 oil actively destroys economic growth. It slows businesses down and drains disposable income from consumer wallets.
Right. And in a normal environment, when economic growth slows, the Federal Reserve cuts interest rates to stimulate borrowing and spending.
But they can't do that here.
No, because this specific oil shock is simultaneously driving up inflation. So they are trapped.
If the Fed potentially operating under hawkish leadership, perhaps someone like Kevin Warsh, if they cut rates in that environment, inflation expectations will absolutely explode.
Exactly. But if they hold rates high or aggressively hike them to fight the inflation, they intentionally collapse economic growth.
It's a lose-lose. The bond market data in our sources shows traders reacting aggressively to this exact dilemma.
Oh, the bond market is screaming right now.
I've seen the term bear flattener used to describe what happens to the Treasury yield curve in this scenario.
Yeah, that's the technical term.
Whenever I hear phrases like that, it sounds like Wall Street jargon meant to confuse people. But is a bear flattener basically like the Fed slamming on the brakes while the economy is already struggling to drive up a steep hill?
The visual of slamming on the brakes perfectly captures the mechanics at play.
Really? How so?
Well, in a bear flattener, short-term borrowing costs, like the 2-year Treasury yield, they jump sharply because they are hypersensitive to the Federal Reserve, keeping their policy rates high to fight inflation.
Okay, so the short-term rates shoot up.
Right, but the 10-year Treasury yield, which represents the long-term economic outlook, also rises, but not as fast.
Why not?
Because it's weighed down by the pessimistic fear that all this aggressive braking by the Fed is going to severely damage future economic growth.
Ah, so the gap between short-term yields and long-term yields shrinks.
Exactly, flattening the curve in a bearish, pessimistic environment.
Now, the research also heavily references the return of the term premium and investors watching TPS break-even rates.
Yes, those are critical indicators.
Can we break down how a break-even rate actually works? Because it seems to be the ultimate indicator of investor panic.
Absolutely. Let's start with the term premium. For a long time, investors didn't demand much extra compensation to lock their money up in a 10-year or 30-year government bond.
Because the prevailing belief was that inflation was essentially dead.
Right. But if inflation becomes unpredictable and volatile due to these energy shocks, investors are going to demand significantly higher yields to take on the risk of locking their capital away for a decade.
Which makes sense. You wouldn't lend someone money for 10 years if you thought the dollar would be worthless.
Exactly. Now, TPS stands for Treasury Inflation Protected Securities. A Brinkman rate is simply the difference in yield between a regular Treasury bond and a TPS bond of the same maturity.
So it's basically a mathematical measurement of exactly what the collective market expects inflation to average over that time period.
You got it.
So if the 5-year and 10-year TPS break-even rates start spiking, it means investors are betting big money that inflation is going to run hot for a very long time.
It is the ultimate red flashing light for central bankers. It signals that the psychology of the market is fundamentally changing, and investors believe inflation is unanchoring from the Federal Reserve's target.
Man, this sounds like an absolute disaster for your retirement account.
Oh, it is.
Specifically, anyone sitting in a standard 60-40 portfolio, 60% stocks, 40% bonds.
Yeah, the classic setup.
Because the traditional logic is that bonds act as your safety net.
Okay.
If the stock market drops because the economy weakens, the Fed usually cuts rates, causing bond yields to fall and bond prices to go up.
Right, your bonds protect your falling stocks.
But in this stagflationary oil shock, the Fed is trapped. Your stocks fall because economic growth is dying, and your bonds fall because inflation and yields are rising.
You lose on both sides simultaneously. The 60-40 portfolio effectively breaks.
And the pain experienced in the financial markets inevitably travels directly to Main Street.
It always does. The mechanism that moves this economic pain from a trading desk in New York to a suburban neighborhood is what economists call the transmission belt.
So how does a rising 10-year Treasury yield actually affect someone listening to this who just wants to buy a house in Ohio or Texas?
Think of the 10-year Treasury yield as the engine and consumer mortgage rates as the wheels.
Okay.
When the Treasury engine speeds up because investors are demanding higher yields to compensate for inflation risk, mortgage rates are dragged forcefully along with it.
Because lenders use the 10-year Treasury as a baseline.
Exactly. If the 10-year yield pushes past 5%, we could easily see 30-year fixed mortgages skyrocket towards 7.5% or even 8%.
8%. Wow.
And furthermore, the profit margin lenders demand on top of the Treasury yield gets much wider during chaotic times.
Why is that?
Because banks need a bigger cushion to protect themselves against market volatility.
You know, when people hear about 8% mortgages and a housing crisis, the immediate assumption is a repeat of 2008.
Sure, that's the Tron response.
But the analyses we're reading suggest something very different. We aren't going to see property values just plummet overnight, are we?
No. The dynamics today are the polar opposite of 2008.
Okay. How so?
Back then, the market suffered from a massive oversupply of homes and subprime adjustable rate loans that forced millions of people to sell their properties in a panic, crashing prices.
Right.
Today, we face a housing ice age. We are looking at a catastrophic volume crash, largely driven by the phenomenon of golden handcuffs.
Ah, the golden handcuffs. This refers to the millions of American families who locked in or refinanced their mortgages when rates were hovering around 2% or 3% a few years ago.
Exactly. A homeowner with a 3% mortgage might look wealthy on paper because their property has appreciated in value, but they are functionally trapped in that specific house.
Because if that family decides to sell their current home to buy a new one, they have to abandon their 3% mortgage and take on a new loan at 8%.
Right. And for the exact same priced house, their monthly payment would effectively double.
Which is insane. Homeowners simply refuse to absorb that mathematical penalty.
Exactly. They stay put, and the supply of existing homes for sale vanishes from the market.
So the sellers are gone. But what happens to the people who desperately want to buy their first home?
First-time buyers run straight into an affordability wall.
Because everything is more expensive.
Yeah. When you combine an 8% mortgage with the reality that gasoline, groceries, and utility bills are all vastly more expensive due to the initial oil shock we discussed, household budgets completely shatter.
And banks look at a buyer's debt-to-income ratio to approve a loan?
Right. With high borrowing costs and high living expenses, millions of aspiring buyers simply can no longer qualify for a mortgage.
So the buyers can't buy, and the sellers refuse to sell. It creates a total deep freeze.
A total ice age.
But I would assume home builders would step in here, to construct more houses to meet the demand. Can't they just build their way out of this?
You'd think so, but home builders face a brutal financial dilemma in this environment.
Really?
Yeah. Recently, builders have managed to keep their sales afloat through something called mortgage rate buydowns. They essentially pay a lump sum upfront to subsidize the buyer's mortgage rate, bringing it down to a manageable level for the first few years.
Oh, that makes sense.
But if the baseline mortgage rate jumps to 8%, paying to buy that rate down to 5% becomes astronomically expensive for the builder.
It just crushes their profit margins.
Completely. They are forced to either absorb massive losses or simply stop breaking ground on new developments.
And halting new construction only exacerbates the underlying national housing shortage.
Exactly.
Man. So if the ownership door slams shut, families are left in a very tight spot. I mean, you still need a bedroom for your growing kids.
Yep.
You still need to live within a specific school district or within commuting distance of your job. If buying a home is mathematically impossible, where do you go?
Well, that's the big question.
The real estate sources point to a massive pressure valve building up in the market.
The single-family rental market becomes the only viable escape hatch. Yeah. When the math of carrying an 8% mortgage detaches completely from median incomes, renting shifts from being a transitional lifestyle choice to a defensive, permanent financial necessity.
So families who spent years saving to buy a detached house are forced to rent one instead.
Exactly.
And hands immense, almost unprecedented pricing power over to corporate landlords.
Institutional single-family rental operators find themselves holding all the cards in this scenario.
Wow.
They experience soaring occupancy rates because retail demand is forcibly funneled into their properties.
And I imagine they benefit from incredibly low tenant turnover.
Oh, absolutely. Their renters renew their leases year after year because they are entirely priced out of the home buying market.
So armed with that trapped demand, corporate landlords gain the leverage to aggressively and consistently raise monthly rents.
Precisely.
We are watching a massive societal shift play out through the acceleration of build-to-rent communities. Our sources show developers literally bypassing the retail home buyer entirely.
Yeah, it's becoming very common.
They are constructing entire subdivisions and selling them directly to institutional rental operators. It feels like we are turning the American starter home into a subscription product.
It is a profound structural change in how wealth is accumulated.
Yeah.
For generations, the starter home served as the primary engine for middle-class wealth creation. A family buys the house, pays down the mortgage over 30 years, and builds equity that they can eventually borrow against or pass down.
But in this high-rate, high-inflation environment, that exact same family is paying monthly rent to a corporate institution to live in that exact same house.
Exactly. The equity is still being built, but it is being aggressively accumulated by the corporate balance sheet, not the family.
It is a staggering shift. But to be fair to the overall picture, the market analyses do highlight that these corporate landlords are not completely invincible.
No, they aren't.
They have a massive vulnerability hidden in how they finance these acquisitions.
Right. Corporate real estate expansion relies heavily on leveraging debt. An institutional buyer acquires properties by borrowing millions of dollars at commercial rates.
Okay.
If their cost of capital spikes to 6% or 7% because the Federal Reserve is fighting inflation, but the home they are purchasing only yields 5% in rental income.
The business model breaks.
Exactly. Their expansion grinds to a halt.
And there's an even bigger danger, right?
Yeah. The bigger danger lies with institutions utilizing floating rate debt. Many corporate buyers use short-term financing that adjusts with the broader market. If they are forced to refinance their massive commercial loans in an 8% environment, their monthly debt servicing costs will explode.
Potentially wiping out all the extra profit they generated from raising rents.
Exactly. Leverage is incredibly powerful on the way up, but it is deeply destructive on the way down.
Okay, let's take a breath and map out the full, uninterrupted chain reaction we have traced in today's deep analysis.
It's a lot to take in.
It is genuinely staggering to see how connected the system is. We start with a geopolitical drone strike overseas.
Right.
That event triggers a 72-hour whiplash in the oil market. Because the physical shock absorbers, the API U.S. crude inventories have been falling for 6 weeks, the market price is in actual scarcity.
Threatening to push crude past $120 a barrel.
And that expensive energy acts as a universal tax, bleeding into core goods and triggering a second-round inflation loop.
Which leads to the Fed trap.
Exactly. The Federal Reserve gets trapped, unable to cut rates to save a slowing economy. Bond yields spike, flattening the curve and breaking the traditional 60-40 retirement portfolio. The 10-year Treasury yield drags 30-year consumer mortgages up to 8%. The housing market plunges into a volume ice age where buyers can't qualify and sellers refuse to abandon their golden handcuffs.
And then finally,
an institutional landlord raises the rent on a single-family home in your neighborhood because you simply have nowhere else to go.
the connectivity is absolute.
So what's the practical way forward for anyone navigating this environment?
The best thing you can do is stop reacting to the noise of daily news headlines and start watching the underlying probabilities.
Pay close attention to the inventory shock absorbers by monitoring the weekly API data.
Exactly. Keep your eyes firmly fixed on the bond market, specifically tracking the 10-year Treasury yield and the TPS break-even rates.
Because those specific metrics are the true, unbiased indicators of structural economic health.
They will flash red, signaling a shift in the macroeconomic winds long before the pain actually arrives in your personal bank account.
We are entering an era where geopolitical energy shocks might fundamentally rewire the structure of society. If you're listening to this, consider this. In the future, the American dream of property ownership might not be lost to domestic policy or local zoning laws, but permanently transformed into a leased service by a volatile global energy grid. Oil is the spark, inflation is the fire, and your housing market is the house that freezes before it burns.